Hi, I'm Anshu Sharma, Portfolio Manager at Loftus Speak. Welcome to Update Plus, a monthly recap of the major disruptive trends shaping global businesses and informing our portfolio positioning. The extreme volatility in the equity markets today is being driven largely by an ever-evolving US trade policy backdrop. Markets are trying to price in long-term implications of these changes, but without a clear framework or consistent messaging from policymakers. This lack of coherence has left participants interpreting each policy move differently, only to have their assumptions overturned the very next day. In this kind of environment, it's crucial to walk you through how we are currently positioned, what steps we have taken to both protect the portfolio and capture opportunities arising from the ongoing market dislocation. But to really understand where we are today, I want to take a step back and revisit some of the key decisions we have made in the recent times. We have maintained a strong bias towards artificial intelligence, high-quality growth companies, and were fully invested near the market bottom in 2022. A decision that felt straightforward, given the valuation comfort we had in our portfolio holdings at that time. That positioning enabled us to generate strong returns for our clients as markets recovered. As the rally continued, however, many of our top-performing names began to lose their valuation advantage. So during the second half of the last year, we recycled the capital into undervalued, overlooked segments of the market. Our thesis was simple. As inflation eased and monetary policy became more accommodative, we expected the rally to broaden, led by a cyclical recovery and supported by attractive valuations. But that view was challenged. Following the inauguration of the new US president, we saw a wave of executive orders and public sector spending cuts, undermining the case for a cyclical recovery. At the same time, talks of new tariffs emerged, bringing with it the risk of renewed inflation, delayed interest rate cuts, potential for low growth, or even stagflation. The result? Market turmoil, heightened uncertainty, growing concern about the prospect of a recession. In the lead up to the 2nd April Liberation Day announcement, we took decisive actions, increased our bias towards quality, we reduced exposure to cyclicals, and we reallocated capital towards Trump-agnostic segments of the market. These adjustments pushed our portfolio further towards long-term secular themes, such as artificial intelligence, cybersecurity, and other high-growth businesses with pricing power and strong strategic positioning. So what have we taken away from the last 20% plus drawdowns in our strategy? First, in uncertain economic environment, the most reliable anchor is valuation comfort. Second, markets tend to overreact to the near-term headwind as though they are permanent. And third, disruptive businesses are not all-weather investments because they are policy-proof. They are compelling because they offer the most efficient commercial solutions to real-world challenges. If we are heading into a world of higher inflation, rising costs, and broader uncertainty, then the companies in our portfolio are exactly the kinds of businesses best positioned to thrive. The recent drawdown gave us the opportunity to reset into high-quality names with powerful tailwinds, and we have done that with renewed confidence in both valuations and business fundamentals. Thanks for tuning in, and we will talk to you next time on Update Plus.